Welcome to our quick discussion of why candlestick patterns fail. Read this, study it, memorize it, take notes, and contact your attorneys immediately. All right, this is me, head trader at Newsbeat, chief barista officer here at T3. I have been a trader for a while, since the 1860s. I'm told I am a price action and momentum trader. And that is my prison mugshot. That's the best I could do. So, behold the candlestick. I was a late adopter to the candlestick. I adopted it, I guess, grudgingly, but it is, in my opinion, a more effective way to view price bar charts. So I just went with the flow. If you're not familiar with candlesticks, your body has your open and close. Green candle means a bullish close. Red candle means bearish close, and your wick signify your highs and lows. So in day trading, as in I think all things, you have a weird phenomenon. There's this meme going around. 98% of traders fail. Trader is a sucker's game, and the only people in this business succeeding are those selling shovels in the gold rush, aka education. I don't know if you've checked around, but something like 90 to 95% of businesses fail. It's an astounding figure. And that is because, in my opinion, and day trading is just a business like any other, ordinary efforts lead to ordinary results. And the problem is that in the education business, I consider myself a bit of an outsider to the whole trading education. I'm very new to this education side of things, but what I've seen as someone who watches the industry a lot is that you're sold in the trading education world packages that promise to deliver great results. They're quite ordinary, and so you think you're putting in extraordinary efforts, but they're really quite ordinary efforts. And so ordinary efforts inexorably lead to ordinary results, whereas extraordinary efforts lead to extraordinary results. And so identifying what it means to put in an extraordinary effort, to see what others don't see, to do the things that others don't do, are the things that truly lead to extraordinary results. So everything you've been taught about candlesticks is wrong. Is that clickbaity or what? Brace yourselves. The angry emails are coming. I can feel it already. I can hear the typing from here. Just kidding. Just kidding. Relax. Candlesticks are wonderful, but they're just a tool. We don't worship wrenches or screwdrivers, right? They're just tools we use. So we're talking about this, and I thought it'd be a fun slide to put in this presentation, right? This is a great metaphor for what it's like to look at the market, right? You're filling in constantly puzzle pieces, and you're ascribing meaning to patterns and data you see on the chart, right? Many times you'll see a great trade, and you'll watch the pattern, you'll watch the action, you'll look at the charts, and you develop a self-confirming bias, and you say, damn it, this is a good trade. This trade means choosing the right bird. Are you sure it doesn't say choosing the right turd? Question mark. Something to ponder. And so we got a bunch of contestants. All right, we need a Vanna White. Anyways, so candlestick analysis is important, but you need to use a top-down approach or a bottom-up approach in this case, so that your interpretation of candlesticks is grounded within a context that mirrors reality more closely. And to do that, I always begin with market structure and then look at price action within that market structure and then look at patterns within that price action. And once all of those check boxes have been checked, then I look to the candlestick signal to properly determine the right entry. So I'm sure you guys have all been bombarded with cheat sheets like this online, right? Do I need to go over these? I think you guys have all seared these into memory. You have the Magnificent Hammer, a crowd favorite in this room, the Dragonfly Doji. These are very strong reversal bars, the bullish engulfing bar, and its closely related second cousin twice removed, the turnaround bar, a crowd favorite, uh, the Morning Star reversal, the three white soldiers, and the rising three, which of course form a bull flag pattern and a continuation. And of course the bearish setups inversely mirror the bullish setups. We trade a lot of evening star reversals. I was very happy to see a sandwich here, which we affectionately call the hot dog. But in essence, candlesticks work very well as signal bars. Taken outside their proper context, however, they can drain your account faster than you can say candlestick. So let's talk about price action. This will be a 5-minute primer of price action. Pop quiz, everybody, for members of the room. What are the characteristics of a breakout? No lower lows, higher highs. There we go. You guys have been paying attention. Very nice. Correct. What's happening here? Bars 1, 2, and 3. Yeah, exactly. So what was once a full-blown breakout is consolidating in a bullish digestive pattern back to a retracement level. Very good. Breakouts occur in both directions, right? This is a bearish breakout. By the way, these are not the perfect charts. I chose these charts specifically because every single chart pattern that you're seeing has occurred in the last week. I wanted to literally grab Moderna and the Qs, maybe throw in a little Tesla to prove a point. These patterns occur every day of our trading lives on every chart we look at, unless you're looking at a buyout. So then we have trends, right? What is typical in a trending channel? What kind of channels do we have to work with? Or World Cup, right? So in a tight bearish channel, we have lower highs, lower lows. In a tight channel, what kind of channel is this, guys? It's a wide channel, correct? Here's an example of a wide channel, right? You had your breakout, your consolidation, inside bar breakout, rising flag, shooting star reversal, lower low. You widen the channel, ledge with a rounding top, lower low. This confirmed the channel. And then you had your turnaround bar and continuation lower, another lower high pivot around the open here. So this is a white channel. And then we have, of course, the dreaded range. A range, as the name implies, in this case, this is a pretty wide range. This is Moderna, like I think 4 days ago. We had some choppy days. A range implies retests of highs that fail and retests of lows that fail. What are typical behaviors of range-bound markets, guys? We talk about this all the time, especially when it's range-bound and slow. Yes. What percentage of breakouts fail in range-bound markets? Correct. Where is our highest risk to reward in a range-bound market? In the extremes, correct. What is our first and foremost commandment for trading range-bound markets? Thou shalt not diddle in the middle. Wow, you guys have been taking notes. So exciting. We're making a difference here at the Newsbeat room. Boom shakalaka, baby. All right, so all together now. What do we have here? What is this? By the way, this is Moderna the past 2 sessions. This is Moderna yesterday. We have a broad channel. What do we call this, guys? This was the dreaded 187.17 level that's been tested for months, right? That is the top of your distribution day. That is the top of your distribution level for the past like 8 months in Moderna, right? So bulls who took Moderna off the 136s are keenly aware of the massive amount of sellers at this level. Once you break a wide channel, there's a few possibilities. You could have a rally, base rally, where you rally off a channel, you base, and you rally for a measured move. How likely is that on a weekly, monthly, and daily range of accumulation at the top of the range? This is the top of Moderna. You guys know this range very well. This is the corner of Take Profits Now Avenue and Initiate Shorts Boulevard, right? Yeah, exactly. Already talking about Wendy. So it's very common to have a broad corrective channel at the top of a distribution range, right? So this is our broad corrective channel. And the broad corrective channel retraces into a trading range. Here's our spring, which we're going to talk about. And once we break the range, sign of strength, breakout. Make sense? So let's talk about Wendy. Hi, I'm Wendy. Don't be scared, homie. Whoops. Why does it do that? So Wendy, of course, is the room mascot for the Wyckoff price cycle. Price in all time frames moves in 4 phases. Most of you have heard this. Most traders I know, it's funny, like they hear this in their first trading course and they kind of blow it off and want to do the sexy stuff. But price is fractal and it's never ending auction of buyers and sellers that goes through 4 phases. Your accumulation, your markup, your distribution, and your markdown. It goes on forever, right? Thank you, Arnie, keeping it classy. So this is the Wyckoff price cycle. So the market can be understood as and anticipated through the detailed analysis of supply and demand, which can be ascertained from studying price action, volume, and time. An idealized schematic of how Wyckoff conceptualized the large interest in preparation for an execution of bull and bear markets is depicted in the figure below, which we're going to look at. The time to enter long orders is towards the end of the preparation for a price mark or bull market, accumulation of large lines of stock, while the time to initiate short positions is at the end, preparation for the markdown. So there are 4 laws, the laws of supply and demand that determine price direction. This is a central principle. It is the core of my trading and many other price action traders in this room. When demand is greater than supply, prices rise, and when supply is greater than demand, prices fall. It's pretty obvious, but somehow people seem to always, due to psychological behavioral reasons, want to buy the market when it's at the very top and sell it when it's at the very, very bottom. Trader analysts can study the balance between supply and demand by comparing price and volume bars over time. This law is deceptively simple, but learning to accurately evaluate supply and demand on bar charts, as well as understanding the implications of supply and demand patterns, takes considerable practice. Type 11, if on a regular basis you see a consolidation working. Yes. Thank you, Lance. And you think there's a good chance for a breakout because it's a reaccumulation zone with a supply demand imbalance, and you watch the bar go up 2, 3 Maraboses in a row, and you buy the top of the bull flag, thinking, okay, this breakout is going to work. Sound familiar? Well, this is why this law is deceptively simple. The law of cause and effect helps a trader and investor set price objectives by gauging the potential extent of a trend emerging from a trading range. This is an underlooked rule, and it's really important. Wyckoff's cause can be measured by the horizontal point count figure chart. I don't use those, but the concept is important. This law's operation can be seen as a force of accumulation and distribution within a trading range, as well as how this force works itself out in a subsequent trend or movement up or down. What kind of cause and effect measurements do we use to gauge targets, guys? Yeah, measured moves, fibs. These are all ways of measuring cause and effect in the capital markets. The law of effort. This is really important. The law of effort versus result provides an early warning of a possible change in uptrend in the near future. Divergences between volume and price often signal a change in direction of price trend. And I'll add this as a technical trader. What are the divergences do we look for on a regular daily basis? Evil JR. Volume, maybe stochastics, SMI, EXY. Correct. Let's talk about the law of effort when it comes to candlesticks for a second, and I'm getting ahead of myself. Is a very high volume shooting star through a double top that fails to close at highs and fails to make a new high, uh, an early warning in the divergences between volume and price, perhaps? The answer is yes, right? That is the idea, the concept behind the dreaded shooting star reversal. So members of this room have seen this many times. This is the basis for ideas of accumulation. This is how we call bottoms so effectively in this room. Notice today, for example, Tesla around 156.50. We said Tesla looks like it's bottoming here after its final selling climax, right? So these schematics, while originally used on monthly, weekly, and daily timeframes, work very effective on on intraday timeframes. So just a quick glossary. Your preliminary support, this is when substantial buying begins at the bottom of your accumulation range to provide pronounced support on a prolonged down move. Volume increases, price spreads widen. signaling the down move may be approaching its end, offers lift, etc. Your selling climax is the point at which widening spread selling pressure usually climaxes, and heavy or panicky selling to the public is being absorbed by larger professional interests. The composite operator, composite man, as it were. Your automatic rally is that first retracement, right? It's that first bounce that occurs when intense selling pressure is greatly diminished. A wave of buying easily pushes prices up, and this further fueled by short covering. These are the pain trades, the Morningstar reversals we take at the bottom of ranges. Understanding the structure in which we take these signal bars and interpret this price action is key to making sure we're taking trades in the right place within the structure of the market. Your secondary test, in which price persists, revisits the area of the selling climax to test the supply-demand balance at these levels, is critical, right? We need confirmation that the bottom is actually catching a bid and not just a retracement on the way lower, where traders usually find religion after bottom fishing a W bottom and then bottom a double bottom, etc. Anybody been finding religion lately while bottom fishing? So the test, large operators always test market for supply throughout the trading range, right? That's why trading ranges can be so tricky. Key prices during the price advance. If considerable supply emerges on a test, the market is often not ready to be marked up. This has happened, for example, in Moderna throughout the first and second quarter of this year, for example. A spring is often followed by one or more tests. A successful test indicating that further price increases will follow typically makes a higher low on lesser volume. What's a good example of the way we deploy springs in this room? What's one of my favorite setups? I would say an Evel Knievel, specifically, yeah. The up thrust reversal, absolutely. Love those. Your last point of support, the low point of a reaction pullback after a sign of strength. Backing up to an LPS means a pullback to support that was formerly resistance on a diminished spread and volume. Of some charts, there may be more than one LPS, despite the ostensibly singular precision of the term. Oftentimes, right, guys, we'll see the selling climax into the bottom. You could look at Tesla today as an example, right? Key pivot, we'll see a bear flag, drop, bear flag, slightly lower low, bear flag fails to make a new low. Remember about 2 hours ago I said, guys, Tesla's bear flag failed to make a lower low on the sell setup. I'm covering here. It looks like this move is done. Remember that? Your last point of support is after the spring, to a sign of strength. That pullback generates the pivot that can give you the 2 or 3 wave corrective. You went long there on the backup. This term is a shorthand for a colorful metaphor coined by Robert Evans, one of the leading teachers of the Wyckoff Method in the 30s to the 60s. Evans analogized the SOS as a jump across a creek of price resistance, right? Could we call Moderna's breakout yesterday a sign of strength, breaking out of its accumulation base? I would. So back to the accumulation schematic, right? Here we go. Preliminary support, break, selling climax, automatic rally, short covering, secondary test. Your secondary test in phase B, often followed by a spring, a shakeout, usually in the form of a hammer, testing the lows. These tests and these LPSs are key to signaling the strength of the accumulation zone. And this was Moderna yesterday, right? That's why we were able to call the 207.75 target so accurately. That 207.75 target was your preliminary support in Moderna. This is a slightly different variation of the schematic. Yeah, exactly. So this is an example of the TAN ETF. A lot of you guys, I think, probably say ENPH in your sleep. Very popular name to trade. So as you guys know, solar showing tremendous relative strength to the market this year. And as we saw after its phase 4 decline, right? The phase 4 decline, just as a reminder, this is Wendy's right side. You had your selling, selling climax, automatic rally, your upthrust, and the reason for this chart here is within the price structure, what manifested here that gave us a good sign that this accumulation zone was going to break out. What do we call this? Yeah, it's a symmetrical triangle or a bull wedge, whatever you want to call it. What matters here is that your spring gave you your sign of strength and you had price volatility contraction with higher lows. This is our bread and butter, guys, right? Price contraction within the right correct market structure to confirm that the demand supply imbalance is going to lead to a trade that actually works. So, Netflix. Some of you guys murdered Netflix this year, taking it long after the secondary test at the bottom of the range. And here was your preliminary support and net. I don't know why this got moved here. I would put it here that 331.77 pivot that we've been testing, right? So this was your selling climax here, your automatic rally, short covering rally, secondary test. Here was your first LPS, your backup, your sign of strength. And finally, you broke out of the accumulation zone. Pop, wedge, pop, wedge. And what do we call this, guys? Tacos. Lance is like, órale, güey. Now you're talking my language. So yeah, a real life example of a fantastic breakout out of an accumulation zone, right? Phase 4 markdown, phase 1, and then using the proper price action and patterns to understand that now we're dealing with a phase 2 uptrend and a very bullish broad channel. So, accumulation patterns. These are the patterns we look for in accumulation and reaccumulation structures, right? Falling wedge, a personal favorite of mine, is a pattern where you make an initial momentum move, one or multiple igniting bars, and then you have a digestive consolidative pattern to a retracement level where price compresses to an apex where the demand supply imbalance is such that buyers reaccumulate and take out highs. This is a very popular pattern. All of us trade this quite a bit in the room. There's the crowd favorite. Exactly. There are traders who shorted the corrective waves, betting that this low would get taken out. When the supply imbalance at the proper retracement fails to go lower, those wanting to catch the measured move of this initial move and those who are on the wrong side of the trade, what do they both do simultaneously? They buy. You guys are on fire. Your cup and handle. Cup and handle, a very bullish continuation reaccumulation pattern. It's most effective, in my opinion, either at reaccumulation ranges. So you have a trending market, you broaden the channel, you set a base, lows are tested, rejected, and another base is built where the accumulation efforts continue. When demand exceeds supply at the initial apex or top of this channel, traders betting on the measured move of leg one enter the trade, right? The W bottom. The W bottom is another accumulation pattern. As the name implies, the W bottom is taken at the bottom of an accumulation or reaccumulation range, right? Within every W bottom, there is a falling wedge. Traders take the falling wedge buy setup. And what is one key advantage of the W bottom trade at the bottom of a range? What is something that traders really like about? It's a very tight stop, right? Very low risk, very easy trade. Then we have the inverse head and shoulders, a beautiful accumulation, reaccumulation, reversal pattern. And you know, in the course I'm designing for the room on momentum and price action, which should hopefully be available in the next couple of months. Uh, the effectiveness of the inverse head and shoulders pattern is amazing. It can occur within multiple places of an accumulation range. So within an accumulation range, you could have your selling climax, your automatic rally, and then you could have the inverse head and shoulders actually form the spring for you, and that's your buy setup, right? At the top of a channel, say you have a tight channel that then broadens out into a broad channel, gives you 3 legs up, breaks the channel, bears enter, buyers come in, the channel break becomes resistance, right? More shorts pile in. Longs take the buy setup. What happens to the shorts at the original channel break pivot? You get cream of bear, exactly. And then bulls look to take the top of the channel as their first target, or a two-wave corrective, or even perhaps a measured move higher. So, distribution structures. This is the top of Wendy's head, right? This is the market after a significant markup. This is how we call tops intraday and for swing trading purposes. So PSY, shorthand for preliminary supply. This is where large interests begin to unload shares in quantity after pronounced up move. Volume expands and price spreads widen, signaling a change in trend that may be approaching. Your buying climax, during which there are often marked increases in volume and spreads. Force of buying reaches a climax with heavier urgent buying by the public being filled by professional interests at prices near the top, right? We often joke that on some of these JP Morgan announcements, retail traders tend to buy the tops, right? They tend to buy buying climaxes. Your automatic rally is, reaction is kind of the inverse of an automatic rally, right? That is your reaction to the buying climax. Your secondary test is the inverse of the accumulation secondary test. Your sign of weakness is the direct inverse of your sign of strength. So it's an observable down move or slightly past the lower boundary of the trading range, of the distribution range that is, usually occurring or an increased spread in volume. The LPSY is your last point of supply. After testing the support of the sign of weakness, a feeble rally on narrow spreads that the market is having considerable difficulty advancing. What is an example of an LPSY as a pattern that we often trade? Mm, I would say a bear flag, a rising wedge, a bearish ledge. Exactly, right? So, oh my goodness, why does this keep on happening? You have a sharp up move, right? Your PSY, your buying climax, right? Here's Mr. FOMO up here, buying the very top, thinking it's going to the moon, right? Your automatic reaction, your secondary test of the high, your sign of weakness, right? When you get that second up thrust and a secondary sign of weakness, you start to oh, that's horrible. You start to create ledges, right? And wedges. These are your last points of supply. So UTAD, your upthrust after distribution, oftentimes in the third phase of a distribution, you had your buying climax here, your sign of weakness, your upthrust, two corrective legs down. Oftentimes the market will test one more time and give you a big upthrust. Which of the mega cap names last year gave you a massive upthrust that trapped and inflicted pain on the maximum amount of market participants? You guys remember? Come on. Mm, I would say Amazon. Do you guys remember Amazon? Zoom. Well, I'm bringing up Amazon. Here's a weekly chart of Amazon. Here was your distribution, your upthrust, your pullback, your UTAD, and after that, you had your sign of weakness, your LPSY, sign of weakness, LPSY. Look at that. Absolutely gross. Alf. All right, so here an example of your XLV and Amazon. Buying climax, automatic reaction, secondary test. You had two up thrusts, and then look at what happened to Amazon. Remember that one time at band camp that Eddie said, "Pray tell JR, what is your target on Amazon?" And I said, "Why, Eddie, it's around $99." And Eddie heartily bellyache laughed at me. Well, there you go. Every action has an equal and opposite reaction in the markets, right? The kinetic energy of all this buying and all of this overhead supply through Amazon's highs created the energy for this measured move. This is how measured moves are calculated in the markets, right? He called it. I was there. I know, KG. I'm not making it up. All right, so here are your distribution patterns. Your topping ledge, your inverse cup and handle, your shallow double top, your head and shoulders top, your bearish rising channel, your bearish rising wedge. The only pattern that is not in the same family as all of these is the shallow double top. It's not often that you just get a double top and it's over, right? Most of the time, after a very large move, there's a heated battle to revisit new highs. That's usually manifested in topping ledges, inverse cup and handles, head and shoulders, bearish rising channels, and rising wedges, right? Your head and shoulders is usually the third leg of a move, where the pullback makes a lower high, at which point there's a debate going on, right? There's two narratives. Some people think this is just a channel broadening. Okay, we're going to consolidate here and then go higher. But those wily bears have other plans, right? They're shorting the top. They're shorting on the way down. Maybe they're adding at the neckline and they're looking for at least a two-wave corrective lower or a measured move off the neckline or a measured move off the head, excuse me, right? I always fondly say, apparently I don't fondly draw, there is a bullish falling wedge within each head and shoulders pattern, and it's a competition to see which side is going to come out victorious. People buying this neckline at the apex are sure that this is just a reaccumulation zone and a channel broadening that'll take out this high. When this neckline breaks, it signifies the supply and demand imbalance brought about by this distribution structure. And the same thing applies for a bearish rising channel, right? When you have a bearish rising channel, so you have your top here, two-wave corrective, bulls come in, they see a channel, and they're betting that this top is going to get taken out. Bears are betting that this channel will break here and here. When you reach the top of your distribution zone, you'll typically have your secondary test, your up thrust. Sometimes you'll have an up thrust, a shallow retracement, and a UTAD here. Bears come in here, and they bet on the channel finally breaking in the reversal. Same thing with the rising wedge, right? So all together now. Here's a bare bones chart. This is the Qs yesterday. There are better charts out there. I wanted to make a point. We see these patterns every single day in the markets. These are not handpicked, carefully edited charts to make a point that looks pretty. We crushed the market yesterday to the long side, to the short side. Many of you guys were shorting the Qs, the ES, Tesla. They're all very similar patterns. So this is the Qs yesterday. Here's a structural view of the market first. Okay. Now, you might say, why JR, there's a buying climax without any buying. Whatever do you mean, sir? Well, have to extrapolate the price movement. This was a what, $15, $12 gap up, right? And there were buys before the market opened that took the market higher. So this was your buying climax, your automatic rally, second test, your up thrust bar, sign of weakness, LPSY, LPSY, and another sign of weakness until what happened? What happened yesterday? Where did we bottom? You tried to clean your screen. Yeah, the closing pivot, right? And then what do we get? We get a mini accumulation structure. This was your selling climax, sign of strength, LPS, a sign of strength, and a channel formed, right? So I'm not writing this stuff down on my chart, and I don't expect you guys to call every tick in the market and use a Wyckoff to English dictionary while you're observing the market. But these concepts are really, really important to understand so that you can look at the price action within the proper context. So here's that chart in price action. B bottom, double top, B bottom break, turnaround bar, right? Lower low, double top. Reversal, lower low, lower low, higher pivot low, higher high, higher high, higher low, higher high, lower high than the pivot, base, higher high, right? So with pivots, you can start to see that the price action view of charting is just as important as the structural view, right? You can't accurately draw patterns and correctly assign signal bars without having the fundament of price action in your chart. So a price action trader who trades without moving averages, indicators, or anything else is seeing a V bottom, a base that failed, 3 legs lower with a reaccumulation here, and they're literally just drawing a measured move at the double top with a target at the lows. This is how a purist price action trader would look at this chart, right? They see 3 bare legs low, a bearish consolidation, and then they're going to expect this pattern if the trend continues because they're looking at a channel, right? They tried to break out of the channel here. Remember the law of effort versus reward? Yeah, 3 legs lower, consolidation, one attempt, second attempt, double top, a lot of effort, but no cigar, right? So price action trader at this point is just looking at a measured move lower here. Do you think a price action trader who looks at signal bars is going to take this shooting star at a double top with great effort placed into breaking it and its failure to break? Do you think they're going to look at this signal bar as a very important signal bar? Yes, right? This same signal bar in the middle of a second leg with great volume and fast tape, do you think a price action trader would take this signal bar seriously? No, we ignore those, right? Those are false signal bars. They go straight to the ignore pile. So now let's add some patterns. Okay? We talked about price action. Now we have patterns. V bottom, platform. Platform fails off the V bottom, right? And makes a lower low. Then you have a sharp rising wedge, breakdown, bear flag, breakdown, rising ledge, breaks down. Understanding patterns within the proper context of price action is absolutely key. So now we have structure at the top, price action. The dynamics of structure and price action are clearly understood, correct? So now patterns are what we start to look for in order to confirm and start to time our entries, right? So you have here in this example uh, a bear flag that broke, tagged the bottom of the range. So now you have two pivots. We start to extrapolate a descending channel, and we have two wave, three wave corrective. We start to draw. This is the process we go through every day, right? We start to draw the ledge here, okay? And now we have a pattern, and we've already drawn the channel. So we have confirmation of price action, confirmation of structure, confirmation of the pattern. What could I possibly be looking for next? Not a trick question. A beer? A signal bar. John's paying attention. Exactly. This is where candlesticks begin to matter. Candlestick signals primarily, right? This is when the shooting star really matters. This is when this bearish engulfing bar really matters, right? You have a beautiful ledge break to the mid channel, a retracement to the top of the channel. Am I going to be taking this bearish engulfing signal bar seriously? You betcha, Spanky, right? Am I going to be taking this hammer seriously into the closing pivot? Remember, we drew this bar off these points, right? They culminate at this hammer. So we have trendline confirmation, closing pivot confirmation. RSI is oversold. We're having some ending volume here, right? Does it make sense to start taking this signal bar seriously in its proper context? Every time, all day, every day. Now, what other pattern is forming here? Yeah, it's an inverse head and shoulders. You could call it a W bottom. What's important about this pattern is that you're testing lows, rejecting them, and setting up a neckline. Your neckline is where it is the inflection point in price at which demand will greatly overwhelm supply, and you're going to see a possible change in trend, right? If this formation was maybe here, would I be taking it as seriously as at the pivot low after a measured move has completed into oversold conditions with ending volume? Not at all, right? It could just be a consolidation. It could be a sideways channel. Your guess is as good as mine. So get our neckline break. Price action trader looks at the double top here. And as with all topping formations, what happens next? What pattern forms here? The bull wedge, right? At this point, we have 1 point, 2 points. Do I usually start extrapolating a channel line with 2 points? Every day. Absolutely. Your job as a trader is to think ahead. Extraordinary efforts yield extraordinary results. Understanding what's happening 10 bars ahead is essential to being able to extrapolate the trade before it happens. So you're not reactive, you're proactive, right? So does this tweezer bottom matter here on a higher low? Another very important candlestick. Absolutely. Does this doji sandwich matter here? 100%. You have a continuation pattern here confirmed by structure, by pattern, and by price action. So being the wily coyotes that we are, and having drawn this channel already, when you hit this higher high and you have a bull flag pattern with two inside dojis forming, are we watching carefully for the break of this bear flag? Somebody finds, yeah. So this signal, bearish engulfing bar, is a signal we pay attention to. There's your three black crows, bear flag. Is this a sell setup and a bearish engulfing bar we pay attention to? Yeah. Now you get your trendline retest here with a higher low. We talked about this last night with Meta, right? Off the lows, am I trying to short this shooting star here, or this shooting star, or this shooting star? Why is this a bad idea? Yeah, it's mid-range on an up move, right? The channels typically move in two waves, sometimes three, but often two. So you're on your first igniting leg higher. This is a very low probability risk, low probability trade. The signal bar is there, but the structure is all wrong. And in terms of price action momentum rules, you're shorting into the first initial momentum move. This is a very bad risk reward and a very generally a poor probability of working. hmm And so that's the anatomy here of a high of day to low of day sequence with a corrective bull channel. Uh, you did not short those. Okay, that's good. So it's 1:30, and we have the FOMC announcement in 30 minutes, and I'm sure a lot of you guys want to get ready for what's coming. Uh, are there any quick questions on what we talked about? Is that being recorded? That was literally a slide, Daniel D. Yes, it's being recorded. Just curious. Hello, channel. How did you extrapolate that? Uh, well, because we are price action traders and we look at things like pivots and volume, right? And measured moves. We completed the measured move into the lows here, into yesterday's lows. This is a demand zone. So the minute we hit this pivot, I'm starting a line, right? I'm extrapolating a trend change here, right? So this inverse head and shoulders is your accumulation zone. This breakout confirms that a phase 2 uptrend intraday is likely, and then I simply draw the top of this channel on a parallel line. Thank you, Kathy. I mean, members of this room, you guys will note that we do this all the time, right? We'll draw the channel before it actually manifests, and it usually fills in quite nicely. And if we're wrong, we're wrong. Oftentimes, you'll have an initial neckline break or a two-wave corrective move higher, and it'll base and roll over, right? But understanding the possible outcomes and being ready for them is what's key. See. Any other questions, guys? I know people are anxious to get ready for the rate announcements. On this chart, General, so? Yuppers, he says, around 240. After that, okay, higher high. I was looking at a bull flag for continuation move 240. Well, that's exactly what happened. The bull wedge broke. It tagged in a higher high and confirmed the uptrend. Francis' disqualification game is coming up. I forgot. Let's see. I'll post it. I'll post it to the announcements window. Isn't it? Oh, thank you, Mickey. That's very kind of you guys.